Hey everybody, welcome to Trading Capital's exclusive analysis. In today's video, we're going to be discussing the major indices: the S&P 500, the Qs, the Russell 2000, the dollar index yields, Bitcoin, gold, and pretty much everything else in between that I think is necessary. All right, today is October 11th, jumping into the S&P 500, the SPY ETF. Notice, first thing and foremost, we have that beautiful head and shoulders that everybody was watching, and it played out to the downside and didn't complete its fully measured move. But if you were to draw the breakdown, the downside target was 408. As of today, you just negated this head and shoulders pattern. Why? Well, you got to close above the neckline on this daily candle. At one point in the market session, it looked as if you were going to get rejected again. Let me just erase that. My apologies. Let me just go back to my drawing tool here. So as I was saying, at one point in the intraday session here, it looked like you were going to get rejected at this neckline, and then the market just snapped back, rallied, and actually made a new high compared to yesterday. Now, it didn't close above there. You can see the wick, but it did get a new daily closing high compared to yesterday's high. So right now, that does negate this head and shoulders. Now, what the interesting thing about this pattern is, one thing's for certain is you often want to wait for another daily close above the wick. Considering you're inside of this wick, this could be a little bit of a bull trap. And why I'm saying that could be a bull trap is because of the fact that CPI is tomorrow, the inflation number. So will the market come in, will the CPI print come in hot, or will it come in line, or will it come in lower? If it comes in line or lower, then I do think this invalidation of the head and shoulders pattern is true. However, if it comes in way hotter and it causes yields in the dollar to spike, I think we could see more of a downside move in the market. How am I positioned? Well, full disclosure, I am positioned more so on the long side, but I have been taking profits as we've been heading into this first resistance point. I do think there's a strong chance we get to the gap fill, but again, with data, especially CPI, it could change things. Now, if the CPI comes in better than expected, what I'm watching on the intraday chart is this beautiful bull flag pattern. Look at this stunning picture perfect bull flag. Big move up, sideways consolidation, big breakout today on the 20-minute chart, also on the hourly chart. So if this flag pattern holds, simply if we do a fib measured move from the low of the flagpole to the high, back down to the low, look at that fib measure move, 44.48 on the SPX. That would imply an upside move based off of this intraday pattern of around 1.6%. We could do that in one single day if the CPI print comes in valid. Now, obviously, it's not my expectation that we have another 1.5 or 1.6% rally in one day, but these markets move so lightning quick that it seems that as soon as you do get a little piece of good news, the market just ramps up and prices it in so quickly. And the same is true. If you get bad news, the markets fall precipitously. So markets move very, very quick, but either way, it should set up for a pretty fantastic opportunity tomorrow. I do like this flag structure heading into tomorrow, and we'll just have to wait and see how it unfolds. The QQQ daily chart, take a look at the Qs. Q's relative strength almost back up to the top end of this parallel channel. That's where I think at the minimum the Qs want to head to, is the upper end of this range. So call it 374.50, give or take a few pennies. You have a gap fill at 377.40. You also have another gap fill sitting at 382. And basically, if you look at the weekly chart, this again is a bigger weekly flag structure. So remember that SPX chart that we just showed you, the intraday 20-minute chart? How this is a small bull flag pattern? Well, if you look at the Qs, it's this exact same pattern except on the weekly chart. And what does the upside of this pattern bring forth to us? Well, if you draw your same Fibonacci tool, take a look at that, 455.82 on the chart. That breaks the all-time high. Now, is there a chance that we don't get there? There sure is. You could go to the 618, briefly piercing the all-time high, but a melt-up is certainly forming on the technical picture in the charts. And one thing that could cause this melt-up, or there's a couple things that could cause this melt-up, is the Fed finally pausing because inflation is lowering fast enough. And secondly, if yields drop fast, I think the algos will, in the near term, price in a quick, sharp move for the tech space, which is what we've been seeing in the mega caps, and they should ultimately lift and carry this market higher. Looking at the IWM here, IWM, interesting as well. Let me just remove some of these trend lines. The IWM, all right, let's just draw our trend line. So we're going to use this double bottom pivot. Look where we closed above yesterday, and we held it today. Today you got the check back off of that support, and you close. Now, what's interesting is you could be forming a little bit of a daily inverse head and shoulder. So you have your left shoulder, you have your head. If this starts to form a right shoulder, then definitely pay attention to this neckline break. If you break this neckline, you could yield a pretty big return, probably up to this gap fill around 185, where you had your consolidation, attempt at a breakout, rejection at the 50-day moving average, and a big failure to the downside. So just remember, this right shoulder is still premature, needs some time to develop, but it could happen. If you break this neckline, you get a pretty decent move all the way to about 185 on the charts. Now, again, this is a daily chart pattern. One thing I want to show you is another intraday pattern. Let's go to the 30-minute chart, shall we? Let's flip to the auto, and I'm just going to change this to regular session hours so the pattern is cleaner. So remember how we were discussing that on the daily chart that you're forming this potential inverse? Look at this on the 30-minute. So I'm just going to erase this key trend line here, but you have this beautiful left shoulder, you have a nice rounded head, and this is forming a beautiful right shoulder already. So on the 30-minute chart, you can actually see that this pattern could potentially yield a lot of upside in the near term if it breaks out. And again, we're talking about a potential move of about 5% in the Russell. And if the small cap breadth in the market really starts to pick up, that's when you see this market squeeze and rip, because there's still a lot of bearish sentiment, there's still a lot of shorts in the market, and all it takes is one positive data feed to start squeezing the market higher in a very, very sharp and parabolic way. So a lot of things that we're watching and discussing as we move forward. Ultimately, it is good that the Russell recaptured this support trend line. That's your big level. If you get a daily close below this level, then it does mean that you could actually test and take out the lows. So just pay attention to that. One thing I'll show you is this topping formation is still in play. Notice how the Russell saw more downside compared to the S&P 500 and the Qs, but it did not fully complete the downside measured move. So notice the relative strength, right? How you have your neckline is all the way up here on the overall Russell, and then you look what the SPY just did today, and it got another close above the neckline. So it makes you wonder, if the SPY is closing above the neckline and starts trending higher, maybe the Russell's actually going to test this area in the coming weeks. That would be a pretty big opportunity on the long side if it does recapture this trend and test the neckline resistance. I would not be surprised if that actually happens. All right, let's move along to the dollar. DXY hitting support, multi-day pullback. Odds of a bounce are favorable. However, what we have to pay attention to is you're starting to break this parabolic move. This on the weekly chart was your 11 consecutive weeks. You got your weekly reversal hammer candle, which is signifying a near-term weekly top. Doesn't mean the dollar is going to fall off a cliff, but it does mean that there's likely going to be some sideways or more consolidation. But being the fact that you are at these pivots, if inflation does come in hot, expect the dollar to actually probably go back above 106.30, 106.50 on the charts, which would be extremely negative for the overall markets. Now, we discussed there was a golden cross that occurred here, which often yields downside. Many investors chase this, and look what happened. You know, you got your golden cross, you had some upside. Most investors are late to the party. They see the golden cross, they hear it on the news, and then they go long the dollar, and then the dollar starts falling. So a lot of interesting dynamics at play here, but I do think that the dollar could see a little bit of a bounce here, maybe back up to this key trend line, but it's really going to be hinging on the fact, what does that CPI print come in? Let's quickly run through yields. The 2-year yield daily chart bouncing off of support here. So the 2-year yield has bounced off of support, but is this going to be a bear flag that's forming? Time will tell. The weekly chart is still okay, holding intact above many of the key moving average. And look, we're still at 4.99. We're below 5, but it's still a pretty big level for the yield market. If we get back above 5%, you could actually test the previous all-time highs around 5.2. But watch this pattern for a bear flag. Watch that 50 daily moving average very closely, because many times we had a kiss of the average, another bounce off of here, another dip but bounce, and now we're consolidating bearishly. So notice the difference between this period, and now this period. So this period is actually putting in potentially a bear flag underneath the 50-day moving average. As opposed to these, you had a little bit of a quick fall and then a big sharp snapback. Quick fall, pierced through the 50, and then a big hammer candle reversal. So I'm watching yields very closely because the bond market is front running, I think, in the near term, a little bit of a cooler CPI, which is interesting because PPI actually came in hotter. But overall, if CPI does come in hotter, this yield market should fall, and I see a gap fill at 4.8, and then obviously this hammer candle will be your big support level in the event that yields do break this area. 10-year yield sitting at 4.5%. Notice how the 10-year yield is now starting to close back underneath this key trend line. That's a huge, huge level for the overall 10-year yield. And what's interesting, if you flip on the monthly chart, is this now, it's still very early, we have 19 days left in the monthly candle, but are you putting in a monthly hammer reversal? Often when you put in a monthly reversal candle, the price action will retest this candle wick the next month, and if that wick holds, then it likely means you have a top for a good 3 to 6 months and could see a pretty big move to the downside coming. But I'm still watching this yield spread. You still have an inversion. I'm waiting for the 2-year yield to drop below the 10-year yield, and that's my big signal for most likely a big market or equity sell-off. Let's move along to gold, oil, and natural gas. So gold, terrific bounce in gold. What has gold now retraced to? Take a look at this. You have these pivot zones over here. You have this pivot zone over here. Gold seems to want to be retesting this overall zone over here. I think that's where gold likely bounces to. Full disclosure, I did sell a lot of my GDX. We took profits on it. But also you can see this beautiful, beautiful parallel channel that gold has been really trading in. And that's where you got your bounce. Pivot high, pivot lows, kissed it, missed it, kissed it over there, kissed it over there. So the chances of you retracing maybe back up to this vicinity are probably very strong. If you get through this resistance pivot at sitting at around 1886, you could see gold retest this area over here around 1927. That's going to be a big confluence level. Why is that? Well, you have this downsloping parallel channel, and then you also have this upsloping parallel channel. Notice how it confluences right in this general vicinity, right at the 200 daily moving average. There's a multi-factor resistance there, and let's say gold moves up into that area over a 2 to 3 day period, a really sharp snapback. That could be a quick scalping short area if you have the confluence of the 200, the confluence of the upsloping parallel channel, the confluence of the downsloping, and a short-term parabolic overbought move. Take a look at GDX. Why did I sell? Well, simply speaking, I sold some yesterday, but I sold the rest of today, closing over around 8%. Basically, the GDX is testing the 50-day moving average. And I'm also a little bit worrisome of oil. Although oil looks to be putting in a potential right shoulder, this right shoulder is a little small in my opinion. I do think that we're going to see maybe one more test of the upside of this 84.50 before oil actually has a big breakdown. Now, if oil has a breakdown of this key trend line, this upsloping trend line, then watch out below, because this is now going to be a potential head and shoulders that has formed. Now, you obviously will have a lot of support at this trend line if you were to retrace back to the breakout zone. But if this head and shoulders does play out and trigger, you're talking about a move down to about 66 bucks on the chart here for oil. Not the base case, but certainly a probable scenario. And you've had comments from the White House coming out telling them that they're going to be working on lowering the price of oil in the near term. So time will tell. Take a look at XOM getting absolutely demolished. Heavy volume on the back of not only oil week, but also on the back of PXD buying out PXD for about, I think, $250 a share. So obviously there was a little bit of liquidity issues and investors not reacting kindly to the deal initially and the lower oil prices. Let's move along to natural gas, because natural gas is so intriguing to me, and I think there's opportunity always in natural gas. So full disclosure, I did short a little bit day trading, and I covered it, and good thing I covered it, because that epic rally off of the lows here. Take a look at this intraday analysis here. So I was watching this parallel channel. Natural gas was trading, had this big dip, and I shorted the KOLD, and natural gas hit this beautiful channel and never looked back. So I was able to, I didn't capture the whole move. I sold right at the top of the channel. So obviously I missed out a big chunk, but it was a quick trade. I mean, you simply look at this intraday 10-minute chart, pivot to pivot, and I was waiting for that downside pivot. Not only did you have a very, very oversold condition, but you had a downside target that was met right at a parallel symmetrical channel, which often provides a very, very good risk to reward setup. Now, what's interesting on the chart here, I'm just going to erase some of these key trend lines just so it cleans up and easier for us to look at. All right, so natural gas. Most people look at nat gas and they see, wow, a big hammer candle reversal. That is bullish. Well, not necessarily. Often the case, this is called a hanging man candle on the daily chart. That is typically bearish. It means there's likely going to be downside or sideways chop. And it's often a candle formation, especially on the daily, that you want to let a few days pass by before you look to get in on the long side. I personally exited all of my natural gas plays, both the equities and the underlying stock, or the Boyle ETF, for a beautiful, beautiful double-digit gain. And now I'm looking to actually potentially short this. I like this hanging man setup for a short. Why? Because I think we could get a pullback of about 7.5% back down to this initial breakout trend line. I think natural gas, based off of this hanging man candle, will see some downside. Maybe it's the inventories that come in a little bit heavier than expected, or perhaps it's just a weak commodity market or something, but who knows? I think based off of this resistance, this hanging man candle, where we're actually trading at, this pivot zone over here, you have multi factors that could be pushing natural gas for a slight pullback in the near term. Long term, medium term, I remain absolutely bullish. I think nat gas is actually going to come up to this level of this 437 after it builds off of this new basing formation. Just remember how this works. You know, if I remove this channel and if I remove this channel, natural gas was basically trading in a channel down here for for a few months, and it just broke out of that channel. Often the case with a breakout in stage one, you get a retest back down to the initial breakout of that stage one basing formation. So I'm waiting for that retest. If natural gas retests here, I would love to go long and pick it up once again and start inching into this underlying commodity. Let me just touch base on something else here now. Bitcoin is finally the last point of discussion. So interesting to see Bitcoin getting a daily close outside of this green bar. That is super, super bearish, not a good sign for Bitcoin. It does lower the probabilities of a Bitcoin bounce at this point in time. But again, if the dollar softens based off of yields, then Bitcoin can continue to surge up. There are some positives though in this price action. What I'll bring to your attention is Bitcoin tagged the 50-day moving average, and you also tagged basically this breakout trend line. Pivot to your pivot, impulse green candle, you've done a full retrace. So there's still a chance that you could bounce all the way back up to this 28,000, but you're putting the probabilities of this pattern turning into a little bit of a weekly bear flag. And what do I mean by that? Well, let's look at the weekly chart of Bitcoin. What is this pattern over here? All of this bearish consolidation inside of this wide range red bar breakdown. It's also happening under a key weekly moving average. So if you look at this, right, Bitcoin had its breakout above the weekly 200. Actually, I'll go back here. Rejection at the weekly 200 MA here. Breakout at the weekly 200. A retest of the weekly 200. So that breakout now turned the previous resistance into support. So you had a breakout, consolidation, and now you're putting in bearish consolidation underneath the weekly 200. So this was resistance, then you flipped it to support, and now it's back to resistance. So that's never a good sign when the price action is really fighting this resistance and support level, and it keeps going back and forth, because eventually the buyers start to become exhausted, and you should likely see a little bit more of a sell-off. But again, it all hinges on that CPI data, because the markets are so influenced by the dollar and what the yield market is doing. So short-term basis, you still have this weekly candle. If you're a long-term bull on Bitcoin, I would watch for a weekly close below this candle. So we're looking at the low is 25,990. If you get a weekly close or a daily close below 25,990, definitely be very, very cautious with going long. However, as long as you remain inside of this weekly candle, you could still move to the high end of the range and then eventually break through and test the previous little cycle high here at 31.64. So lots of interesting price action today. Obviously you saw a lot of the miners sell off, but it'll be interesting to see how the rest of the market shapes up off of the CPI print tomorrow. Please give this video a like down below if you're interested in how I'm trading many of these setups. Definitely visit tradingcapital.ca, where we run a live Discord trading service where we give you constant analysis, charts, insights, fundamental analysis, and all the research and time that we put